Hi, IBD. I'm Meredith Heyman. This is IBD Explains. Thanks so much for joining me. Berkshire Hathaway Chairman and CEO Warren Buffett is known as one of the most accomplished investors ever. But some of the tenets of Buffett's success may differ from the IBD methodology. Joining me to compare and contrast IBD's teaching with that of Warren Buffett is IBD Markets reporter Justin Nielsen. Hey, Justin, thanks so much for joining me.
Thanks for having me, Meredith.
Absolutely. All right. So let's learn how to do things just like Warren and, how to stick with what IBD already tells us. So when it comes to investing, how are the lessons from IBD and Warren Buffett the same?
Well, I think number one, and a lot of the IBD tenants came from Bill O'Neill, the founder of Investors Business Daily. And I had the pleasure of working as his assistant for 15 years. So I definitely know backwards and forwards Bill's thinking on things, which again launched the IBD methodology. But for Warren Buffett, we kind of have to go more from books, interviews, and those Berkshire Hathaway stockholder meetings and great letters that he writes, which has been over years. One of the things that I think they both have in common, a big thing, and I find this across a lot of the best investors of all time, risk management. Risk management is such a key concept for both of them. For Bill O'Neill, he often said, keeping losses small was rule number one. He had the 7%, 8% stop loss from the purchase price as a rule that he just never wanted to see broken. Now, Warren Buffett, he infamously has said, there are two rules to investing. Number one, don't lose money. Number two, don't forget rule number one. So you can see both guys had a very big belief in that a huge part of investing was to not lose too much money. It's going to happen, but you want to be keeping your losses small whenever possible. And this is what allows you to keep on playing the game because, as we'll discuss a little bit later, longevity matters. There's a couple parts to it, right? There is the protecting capital. You don't want to put more money into things that aren't working. I mean, Bill O'Neill a lot of times said, look, I'm not going to average down because I don't want to be writing something and in case I'm wrong, have an issue where I'm putting more money after, bad money, really. Now, for Buffett, he really kind of looked, whereas O'Neill maybe looked a little bit more at the stock chart to kind of tell him that information. Buffett would really look at the fundamentals of the company. He would be reading the story of how the company was doing, the financial reports, specifically the footnotes. And so his risk management style, although a little bit different, he was kind of coming up with this what he called the margin of safety, where he was making sure that the value that he was buying the company at, that stock price that he was buying the company at, was worth a little bit more than what he was paying, that the company had extra assets or things that maybe weren't being valued properly. And so that margin kind of let him have that risk management where he knew that he wasn't going to get too hurt on something because he really knew the fundamentals of the company very well.
Mm-hmm. So we have the similarities. How are what IBD teaches different than Warren Buffett's approach?
Well, that Buffett approach of really kind of digging deep into the fundamentals, both O'Neill and Buffett believe in fundamentals, but O'Neill was more on the growth side, whereas Buffett was looking for those concepts of value that he could find. O'Neill was really looking for those companies that were growers, that they were having these phenomenal earnings growth records, and that they were doing something so different, changing the way that we work, that the way that we live, the way that we play. And so he was really kind of looking for those that would entice more people to buy into the company because of what it was doing, because of how it was growing. Now, whereas Buffett might be very big on the dividend payers, he really liked those cash cows, and that's why he's got so many insurance companies. They just produce a lot of cash, and then he can use that cash to sometimes buy companies outright. O'Neill believed that a lot of times those growth companies, it was okay that they weren't paying a dividend because they were reinvesting in themselves for that expansion phase. And those expansion phases could be very lucrative, but also short-lived. So that was one of the things, whereas I would say O'Neill's longest holding was a pick and save investment that he had in the 70s over 7.5 years. Buffett, on the other hand, he's had some investments for decades.
But there is also some flexibility to figure out which approach it works best for you as an investor. There are different roads that can lead to the same kind of Warren Buffett success, right, Justin?
Absolutely. Whether you do it through growth, whether you do it through value, there's a lot of different ways. And I mean, if you read some of the best traders of all time, you find that they have different ways of getting there. But I would say be very cognizant of those similarities. That biggest one is that risk management factor, being very careful to protect yourself from taking big losses because longevity matters. You got to think about that power of compounding. And look, Buffett, he's over 90 now. Bill O'Neill, he lived to be 90. So they had both of them 70 years of investing and compounding over that kind of period of time can really make a big difference in building a fortune. Now, the other lever for compounding is performance. And both men had very good performance as well. So being able to do that over time is phenomenal. So those are the two levers you have to work for. And the longevity is one of those things that, I mean, we can control that a little bit better than our performance. And by longevity, I just mean that you're controlling your risks to the point where you're not going to be out of the game, because we've seen too many of these cases, and you can go back through history where people blow up their accounts, they're out of the game, and then they can never come back from it. But if you can keep your losses small, keep your drawdown small, then you always live to fight another day.
What are some examples of some of Buffett's biggest wins?
You got to remember that one of the things that does make Buffett a little bit different, not something that everyone can do, is sometimes he's buying companies outright. And that was the case of See's Candies. He bought that company outright, and that was a big winner for him. He's also had investments in things like Coca-Cola over decades. American Express, he got that at kind of a discount when there was a big scandal going on. And so he got that at a discount and held on to that for a long time. And then, of course, there's Geico. He got a lesson from Benjamin Graham, the famed value investor, very early on in his career, and it really turned him on to insurance products. Berkshire Hathaway itself, while the name is synonymous with Warren Buffett, the investment itself in Berkshire Hathaway wasn't a great one. It was a textile company, and the way I've heard the story, Buffett was kind of going in for revenge because he got swindled by the CEO. So he took the company over to basically get that CEO out. But it ended up being one of those things that ended up being very costly for him. Now, of course, he eventually sold that textile business and kept the name Berkshire Hathaway as a holding company for all of these companies that he's created or bought into over the years. So it's a mixed bag. Berkshire Hathaway itself is a great stock story of success, but the company, the textile company, certainly didn't start out that way.
So, Justin, all in all, what would you say is the most important lesson from Warren Buffett that active growth investors can use to become more successful in their trading?
Well, even though Warren Buffett's style is very different from what most active growth investors would use, I think one of the things that you can learn from Warren Buffett is, again, not to sound like a broken record here, but paying attention to that risk management side of things, not letting small losses turn into big losses. His concept of don't lose money. Don't forget rule number one. All of these things. This is something that is not singular to Warren Buffett. This is something that I've seen across a lot of different traders, across a lot of different disciplines and styles. But this is part of what makes them great. And also, I think it's having that discipline, a routine that you go through and rules that you follow so that you're not just using emotions to make your investing decisions, but you're using cold, hard facts as much as possible to counter those emotions. Because let's face it, investing can be a very emotional game. Your hard-earned money is going up and down and fluctuating. So you have to have things to kind of counteract those emotions. Rules and discipline are the best things. And I think Warren Buffett is a great example of someone who's applied rules and discipline throughout his life.
All right, Justin, very valuable lessons. Thanks so much for joining me. This is IBD Explains. I'm Meredith Heyman. Thanks so much for watching IBD. We'll see you next time.